Welcome back to Iron Financial. We're the only show dedicated to helping you forge a stronger portfolio by hammering through the market's weaknesses. I'm your lead analyst, and with me, as always, is our market skeptic. Today, we've got a company on the ropes, FutureFuel Corp., ticker FF. Folks, their latest earnings report wasn't just bad, it was a bloodbath, and it sent shockwaves through the market. So the big question we're tackling today is this. Is the company's framework strong enough to handle this kind of hit, or are we watching the beginning of a complete structural meltdown? Let's get into it and start hammering away.
Okay, let's just put the headline number right up front, the one that caused the panic. For the full year 2025, a net loss of $49.4 million. Look, this isn't a rounding error or a slightly off quarter. This is a gaping wound on the balance sheet. Just a year ago, this company was actually making money. Now it's hemorrhaging cash. If you're an investor, this number isn't just a red flag. It's a 5-alarm fire bell screaming that the fundamental structure of this company is failing. This is the kind of bottom-line devastation that can absolutely cripple a business if they don't stop the bleeding, and fast.
And if you thought that last number was bad, well, buckle up. Revenue collapsed by 61% year over year. They went from over $243 million in sales all the way down to just $95 million. This isn't just a crack in the foundation, people. The whole damn wall has come down. When your top line, your sales, gets cut by more than half in a single year, it tells you that your core business model is under a brutal existential assault. You simply cannot sustain a business, let alone talk about growth, when your revenue stream is evaporating this quickly. It's a total catastrophe on the income statement.
Okay, hold on, analyst. Those are some absolute knockout punches, a complete financial wreck. So, where do we even begin to sift through this rubble? How are you going to break this down for us?
Well, you treat it like a structural engineering problem. We're going to conduct a full forensic investigation. First, we'll dive deeper into that earnings alarm, which has put this company on code red. Then, we're going to file a complete financial damage report to really assess the structural integrity, or lack thereof. After that, we'll put the CEO's so-called turnaround blueprint under the microscope. From there, we'll do a full breakdown, a real deep dive into their two key divisions, biofuels versus chemicals, to see what's really happening under the surface. And then, at the end, we'll deliver our final verdict. Is this a rare chance to buy a beaten-down asset, or is it a classic value trap just waiting to snap shut?
All right, let's not waste any time. I want to see that damage report. Before we can even begin to talk about a rebuild, we need to walk through the wreckage and see how bad it really is. You got it. That's exactly right. It is time to examine the full extent of this financial damage. We're assessing the company's core structural integrity. We need to find out right now if the foundation is even salvageable, or if it's been fractured beyond any hope of repair.
Okay, Exhibit A. Let's put these 2 years in the ring, side by side. The visual here tells the entire story, and it is a brutal one. Over on the right, you've got fiscal year 2024. Everything's looking good. Solid revenue, positive net income of $15.5 million, healthy EBITDA, a profitable working company. Then, bam, look to the left at 2025. Total devastation. Revenue collapses by more than $140 million. That $15 million in profit evaporates and becomes a nearly $50 million loss. And that healthy EBITDA, it swings to a gut-wrenching negative $38 million. This isn't a slow decline. It's a complete and total reversal of fortune, the financial equivalent of a building being imploded.
Okay, so they're losing money hand over fist, we've established that. But what about their cash reserves? What's their war chest look like? Can they even afford to survive this disaster? This chart? This is not good. No, it's not. This is the ticking clock in the background of this whole story. At the end of 2024, they were sitting on a pretty solid cash pile, almost $110 million. Fast forward just 1 year, and that pile has been torched. It's been cut by more than half, down to just $51 million. They are burning through their savings at an absolutely terrifying pace. So at this rate, forget about a turnaround for a second. Do they even have enough money to keep the lights on? How long can they last? That is the race against time they're in right now. That cash burn rate is unsustainable.
And that question gets even more critical when you look at this next slide. Now, you might be thinking, hey, maybe it's just a tough environment. Maybe the whole industry is getting hammered. Nope. Not even close. The data shows that while FutureFuel's earnings have been plummeting at an average annual clip of almost 34%, the broader oil and gas industry has been growing at a healthy 17.8% a year. This slide proves it. The problem isn't just a rough market. This is a company-specific failure. This isn't a case of all ships sinking in a storm. This is a ship with a massive hole in its hull, taking on water fast, while the rest of the fleet is sailing on just fine. It points to deep, fundamental, internal issues.
All right, so the house is on fire. The numbers are a complete disaster. It's an internal problem, not an external one. So, where's the C-suite? What's the spin coming from the corner office? What are they telling people? That's the logical next question. We've seen the damage. Now we have to analyze management's plan to fix it. We need to look at their blueprint for the repairs. And the big question is this a solid, credible plan for a major rebuild? Or is it just a flimsy facade they've thrown up to try and calm down panicked investors?
So here it is, the official story, straight from the CEO, Roland Pollett. In the earnings release, he said, and I quote, "We utilize this period to fortify our foundations, focusing on operational turnarounds and enhancing plant reliability." So the narrative they're pushing is that this brutal downturn wasn't just a disaster, it was a strategic choice. They're claiming they used this period of immense financial pain to shut down the broken parts of the business and strengthen the company's core for the future. It's the classic turnaround story. We're taking our medicine now so we can come back stronger than ever.
Yeah, fortifying foundations. I gotta be honest, analyst, that sounds like corporate jargon to me. When I see revenue fall off a cliff and a $50 million loss, my brain doesn't go to fortification, it goes to catastrophe. So is this a real strategic overhaul, or are they just putting up some drywall to hide massive structural cracks in the foundation? How do we know enhancing plant reliability isn't just code for our main business completely imploded and we're scrambling to find anything else that works? I need to see some proof. You have hit the nail directly on the head. Talk is cheap, especially in an earnings report. We need hard evidence. And to get that, we have to perform an autopsy on the company's main business segments. Let's think of them as the two primary load-bearing beams holding this entire company up: biofuels and chemicals. We are going to put each one of them on the operating table and see which one is actually carrying the load and which one is about to snap. Let's start with the original foundation of the company, the biofuels segment. This is their legacy business. This is their old guard. And well, this is ground zero for the financial explosion. This single segment was the primary driver of that catastrophic revenue collapse we saw earlier. It wasn't just struggling, it was facing what the company diplomatically calls significant headwinds. In reality, it was getting pummeled from every possible direction.
And here are those headwinds. It wasn't just one thing that went wrong. It was everything that could go wrong, all at once. It was a perfect storm. First, the government pulled the plug on a key subsidy, the blender's tax credit. Then there was total chaos and uncertainty about its replacement, which basically froze the market. While that was happening, the cost of their raw materials, their feedstock, went through the roof, absolutely crushing their profit margins. So what did management do? They made a strategic decision to dump inventory in the first half of the year, and then they just gave up and paused all production. Put simply, regulatory hell and terrible economics forced them to turn off their main money-making engine.
So biofuels is a complete dumpster fire. The old foundation has crumbled into dust. What's plan B? They have to have a plan B, right? They do. And their entire future is riding on it. The company is now making a hard pivot. They're trying to position their chemical segment as the new foundation, the new cornerstone for all future growth. This is their Hail Mary pass. The whole turnaround story, everything, depends on whether this segment can take off, and take off fast enough to make up for the crater left by their legacy business. This is the new beam they hope can support the entire structure. And they claim it's not just a hope, they've got a blueprint. Here's their strategic plan for chemicals, step by step. Step 1 was the big one: build a brand new methacrylate plant. They did that. According to their reports, that plant became operational near the end of 2025. Now they're in step 3, which is a critical phase, getting their product qualified with customers, proving it works. And if, and it's a big if, all of that goes well, step 4 is the goal: to start generating what they call meaningful revenue this year in 2026. This is their roadmap to profitability. Okay, analyst, let's put it all together. You've got one business, biofuels, that's in ruins. And you've got a brand new one, chemicals, that hasn't made a meaningful dime yet. The company is basically asking investors to trust them, to believe that this new, unproven construction project is going to be strong enough to replace the old, crumbling foundation. So let's get to it, the final verdict. Is an investor looking at a condemned structure that's about to be demolished? Or is this a ground floor opportunity to get in on a major rebuild? What's the call? This is where the battle lines are drawn, because honestly, you can make a compelling argument for both sides. Let's look at the bull case first, the people who believe in the rebuild. They'll point to some really solid structural supports. First, the company has zero debt. That's a massive advantage. Second, that new chemicals plant is built and it's coming online. third, the regulatory mess in biofuels has finally been sorted out. And maybe most importantly, the CEO is putting his own money where his mouth is. He's buying stock. But the bears, who are predicting a teardown, have just as much ammunition. They'll point to that insane cash burn, the revenue collapse, the deep negative margins, a terrible history of earnings growth, and the cold, hard fact that this turnaround is, right now, just a story. It is 100% unproven.
And this brings us right to the heart of one of the biggest dangers for investors, the value trap. For anyone listening, a value trap is a stock that looks incredibly cheap on paper. You see that beaten down share price and you think, wow, what a bargain. But it's cheap for a very good reason. It's cheap because the business is fundamentally broken, because its earnings are in a death spiral. So the ultimate question for anyone even thinking about this stock is this. Is FutureFuel a genuine bargain, or is that low price a giant flashing red warning sign of much deeper, unresolved structural problems?
Okay, let's put the evidence on the scales, point for point. Pro. The company has zero debt. I cannot overstate how huge that is. It gives them stability and breathing room that most struggling companies would kill for. But the con? A negative 20.5% return on equity. That's a critical number. It means management is literally destroying shareholder value. For every dollar invested, they are losing 20 cents. Pro. The CEO, Roland Pollitt, just bought 15,000 shares with his own cash. That's a powerful signal of insider confidence. But the con, that ugly history we saw, earnings have been shrinking by over 33% a year while their competitors are growing. Pro. That new chemical plant is built and ready to go. It offers a real path to a new revenue stream. But the con? Even if biofuels recovers, it's still at the mercy of volatile commodity prices, meaning profits could vanish overnight. So where does this all leave us? FutureFuel is at a crossroads, a true inflection point. You can see the blueprint for a turnaround. It's there, centered on the new chemicals plant and a potential rebound in biofuels. The fact that they have no debt is a massive pillar of support holding things up. But, and it's a huge but, the financial damage has been severe. That cash burn is absolutely unsustainable, and their ability to make a profit has been completely shattered. The heavy lifting on this turnaround has barely even started. So that brings us to our final question, the one you have to ask yourself as an investor. Is the foundation, with zero debt and a new growth plan, solid enough to support a successful rebuild? Or is the structure so weakened by this last storm that the next one will bring the whole thing crashing down? That right there is the multi-million-dollar question.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.